Good afternoon, listeners. I'm Bill Baruch, president of Blue Line Capital, and I'm here with our analyst, Jannis Meindl. And we have a special video here for you today talking about today's CPI number, how we're digesting it, and what we're doing in the aftermath, seeing the equity market here today finish a bit lower in the session. This was it was an encouraging CPI number, but it really wasn't outside of the realm of expectations. Inflation in general, CPI, and inflation have been trending lower. There's also the sort of narrative of a slowing economy that also has already priced in and discounted this slowing inflation within the market. So we saw headline CPI year over year come in at 5.0%. This is the lowest level since May of 2021. We also have an increase of month over month CPI of only 10 basis points. Which was lower than the 20 basis points expected. Now, core CPI at 5.6% was a little bit above that February number of 5.5%. So we're starting to see, obviously the confirmation that inflation is slowing. But why did the market sell off today? And what does that mean? Well, the S&P futures, in response to this inflation data, did trade to 41.77. And, we put out research every single day that 41.77 was our major three-star resistance in our futures research that goes out to clients. So that's a big level. We couldn't get through that. Now, you have to remember, again, we're discounting slowing inflation already. This just broadly the market is. And we had this tailwind into the end of quarter one, where markets finished really broadly stronger. So they're sort of just going through this digestion pattern right now. And again, the data itself really wasn't deviating. Now, the highlights within the data, I think, are really terrific because you got shelter and you have services. They're both coming in lower than their 3-month and 6-month and 12-month trends. And then services X rents is actually disinflated by 3 basis points. So within the data, there is some really, really interesting pieces here and very encouraging pieces for the Fed. The problem is, the Fed is not going to change their narrative until the moment in time they're ready. And that's something we've been talking about because of the market's reaction function. And they're not ready to change that narrative yet. We heard that from the Fed minutes this afternoon, and some of those Fed members saying outside the banking crisis that they would have been looking to hike 50 basis points. And remember, Fed Chair Powell got very hawkish in March, right before the banking number. He basically broke the banking sector the day that he sent the 2-year yield above 5%, flip-flopping from February. So I think the Fed themselves are trying to work through all this data and wonkiness. Jannis, what do you think about what you're seeing here today?
Yeah, I would echo all these points, and especially in the services, less shelter, which we do know is a lagging indicator because of the way the renewed rents work. Those are really encouraging because really coming into this year, the problem a lot of investors really had with the way that the inflation was shaking up was the concern around the wage price spiral and what that would ultimately mean for the Fed's inflation targeting. It was Jay Powell himself who dissected inflation into these 3 categories of goods, services, and then shelter itself. And he was really targeting the services less rent component of inflation, which is really your indication of how wages look in the economy, the fact that we're seeing a deceleration there, but also a continued decline in the good on the good side in CPI. I think all these trends are really encouraging, and they have been pointing in that direction for quite a few reports now. If we just look at the 3-month average annualized figures across the board, I think that there's not too much to be concerned with just looking at inflation in isolation here. But I think more importantly, it's the market's reaction today. And what does that mean? You touched on that. And maybe the market responding to an anticipation of what the Fed is going to do. I think it is encouraging to see copper and crude oil as those cyclical commodities respond positively, despite stocks selling off here this afternoon. But yeah, we'll see how it shakes out. And we'll also get PPI tomorrow and then pulse in the consumer on Friday with retail sales.
Yeah, you're right. It's PPI tomorrow, and PPI has also shown some signs of disinflation. That's important. And really, as we're looking to that May 3rd Fed meeting, expectations right now are about 69% chance probability that they will hike 25 basis points. At the end of the day, what does this mean for positioning? What have we done? We've been very bullish on tech because rates have been coming down. That was something that we've been putting cash to work from February and through the middle part of March on some of that weakness that we saw coming out of that strong start to the year. getting into and adding to positions in tech and adding to positions that we like. We added more to NVIDIA at the right time after trimming it previously. NVIDIA ultimately was our number one position as in their aggressive portfolios, weighting nearly 50% in tech. Because looking at it from the idea of bring out your 2019 playbook, at the end of 2018, the Fed hiked rates 25 basis points after the S&P was down 17%. And the market actually bottomed 3 days later. Now, I think a lot of that bottoming had to do with quadruple witching, but that's neither here nor there. The market did bottom 3 days after the Fed hiked 25 basis points. And then the NASDAQ was up 40% in 2019. And at that time in December 2018, they said they were going to hike 2 more times in 2019. Everybody knew they were not going to, but they had to communicate it that way. And it's very similar to the way they're communicating right now. And they ended up in 2019 at cutting rates. I think it was the first cut was in May. So I think we're seeing a very good parallel there. Regardless, though, NVIDIA has become a very, very sizable position in our portfolio. There's some signs of stalling after making a record high against relative to the NASDAQ as the denominator of price. That NVIDIA did that 2 weeks ago. So we began trimming NVIDIA a little bit. Today's close in general was just a little bit of a reason to be concerned. Now, the market has done nothing wrong other than NASDAQ closing at some of the lowest levels. The S&P holding above 4,100 is very encouraging. It's the S&P that we want to watch into some of those opening day ranges. Going back to Wednesday and Thursday of the final week of the quarter. We don't want to see those levels start to get surrendered. If we start going below there could be a little bit more of a fallback in the market. But we find this very encouraging. The real question is the market, is good news going to be bad for the market, or is good news going to be good for the market? And, I think that's where we find ourselves right now. If you look back at some of the recession trade that came in the forefront last week, and you had Deere and Caterpillar sharply lower, and now they've rebounded. And then with the Fed not changing their narrative, some of these industrials, do we need to see good news in order to kind of put away this recession trade? And that's some of the answers that we hope to get from, seeing PPI, we have retail sales Friday. And as we move into next week before the blackout period, before the Fed can't talk anymore. So we're going to get a lot of Fed speak. And really, it doesn't change anything for us. It's just about staying nimble. As we look at from a positioning standpoint, as we get more answers. But if we start closing below 40, 80, 40, 90 in the S&P, and maybe time to raise a little bit of cash is how we're viewing it. Jannis, any insight on that?
Absolutely. I mean, with the reaction function of the Fed, are they going to hike just to make a point? They are expected to cut 50 basis points by year end from this level. And it's 75 basis points really after they will have maybe hiked at the beginning of May. But yeah, I think it's a lot about the reaction function. Markets just waiting for perhaps this all clear sign so investors can indeed pull out the 2019 playbook with low growth, low inflation. We'll see how that shakes out.
Absolutely. Well, if you want more information on how we're positioning, what we're doing for our clients, please don't hesitate to reach out. We love connecting with our listeners. We love connecting with people. Our information is on the bottom there, info@bluelinecapllc.com. Shoot us an email, learn about what we're doing, again, with our wealth portfolios, our thematic equity builds, but we also manage money in the commodity space too. So we'd love to connect with you. We're very excited about commodities through this year and potential China impulse. So if you want to learn more about that, reach out to us. We'd love to connect with you. info@bluelinecapllc.com. Thanks a lot for listening. Bill Baruch is the founder and CEO of Blue Line Capital. All opinions expressed by Bill and podcast guests are solely their own opinions and are not intended to provide specific advice or recommendations. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Understand your financial condition before investing. Blue Line Capital, its staff, or its clients may maintain positions in the securities discussed in this podcast.